Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Well, new year, new me. I have done 4 straight podcasts. That has got to be a record for me. Four in a row? Monday, Tuesday, Wednesday, Thursday. I don't know. Should I do one on Friday? We do have a jobs report coming out. Maybe do one Friday morning. We'll see. But we are doing the Thursday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer at Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down the big stories that are moving mortgage rates every single day and do it in 15 minutes or less. Every single weekday, I should say, not including Friday. Another caveat, another exception to that statement. What's crazy is you're not going to be surprised by this, but what do you think mortgage rates are doing today? So yesterday they were down. Day before they were up. Day before they were down. So what do you think they're doing today? Yes, they're up. I'll tell you, the chart of the 10-year since about the middle of December is like a heart monitor. It's like up, down, up, down, up, down. And just all within this range of like, it's between about 4.2% and 4.1%. So we're moving within basically like 10 basis points is what we are doing. And so if it goes up 3 basis points, the next day it will fall 3 basis points. And that's basically what's happened this week. And so once again, it was down. So now we're up again. Rates are, the 10 years about 4.17%. Mortgage News Daily had the 30-year fixed at 4.21%. That was actually a 2 basis point jump. Last couple of days had been, up 1 basis point, down 1 basis point, up 1 basis point. So basically rates are just kind of bouncing around in this kind of narrow range bound, I believe is the term that fancy people use. Range bound is what kind of where we are. I mean, we're just sort of stuck in that, 4.2, 4.1. It's kind of where we've been for the last almost month. And, things could change tomorrow because we are getting a jobs report, a timely jobs report that has followed a week of labor market data. We did get a jobless claims report. We're going to talk about that in a second. But just sort of recap what's happened this week. We got job openings falling to the lowest level in 13 months. That was sort of a surprise and showed, maybe there's some weakening labor market. Very kind of low private payroll report from ADP. But then today, on Thursday, we got jobless claims. Jobless claims rose modestly in the first week of the new year, but maintained that sort of kind of low range that it's been in for the last few weeks. In fact, looking at the numbers, jobless claims jumped to about 208,000 for the week ending January the 3rd. That was an 8,000 jump. And despite the increase, though, claims are still at the third lowest level in the past year. Past 12 months, third lowest level that we have seen. So what that's showing you is that we're not seeing massive layoffs. We're not seeing a big spike in layoffs. And this goes back to this argument that Jerome Powell made, I want to say 3 or 4 months ago, this sort of low hire, low fire environment where you're not seeing a lot of people getting hired, hence the very low private payrolls. And then I think tomorrow, what is the number we're expecting tomorrow? Like 45,000. So, very similar. We saw 41,000 private payrolls. So they're projecting 45,000 kind of overall for the economy. That's low. That's low. So we're not seeing a lot of hires. We're not seeing a lot of fires. So this latest jobless claims report sort of continues that. And we did see continuing claims. They did jump like jobless claims, jumping 56,000 from the previous week's revised level to 1.914 million. However, once again, even with that rise, that is the fourth lowest level in the last 7 months. So even continuing claims, which we did see rise the latter part of 2025, has kind of fallen in the fact that this is the fourth lowest level in the last 7 months. So we're seeing a little bit of improvement in long-term unemployment, but nothing really crazy with the initial jobless claims. And so it's just kind of a stable labor market. I mean, stable in that we are seeing weakening. Things, are getting a little bit worse, but it's nothing. It's not happening quickly, I should say. And so it's nothing that the Fed, oh my gosh, is going to have to move or make some big change to monetary policy at their first meeting this year. So they're like, all right, things are just kind of moving along with the labor market. And so that's one of the reasons why I think you saw a little bit of a rise in the 10-year bond markets, kind of seeing this is because those other two reports were maybe a little concerning. But this one's all right, well, haven't seen that big jump in jobless claims. And so tomorrow's report's going to be big. So like I said, we may do a show. Whenever I say that, though, I never do it. So we'll see what happens. We did also get another report that doesn't really have a huge impact on bonds and therefore mortgage rates, but is something important to look at. And that, of course, is our trade deficit, our balance of trade report that we get from the Bureau of Economic Analysis. And man, oh man, what a surprise. The U.S. trade deficit fell sharply to end 2025, hitting its lowest level in more than a decade. Actually, almost closer to 2 decades. The U.S. trade deficit narrowed to $29.4 billion in December, down from $48.1 billion in November. So that's a big drop. And that is the lowest number that we have seen since June 2009. So actually, you know what? I'm sorry. I did my math wrong on that. That's 16 years. That's over 16 years, not 15 years. 16 years. Not quite 17, but over 16 years. Exports climbed to $302 billion in December, a 2.6% jump, and that is the highest level on record. Imports, however, fell to $331 billion. That was a 3.2% drop from the prior month, and that's the lowest level since January 2004. So we're still seeing exports climbing. Nothing crazy, kind of the traditional pattern that we have seen over the lifespan of globalism, or globalization, I should say. And imports, though, are clearly reversing. And we're not seeing that continued growth of both exports and imports. Imports are pulling back. Now, normally, when you see a reduction in the trade deficit, it's a sign of a slowdown in the domestic economy, because all of a sudden companies are not buying things from their foreign suppliers. People aren't buying things overseas. However, we know that this is actually one of the goals of the current administration. President Donald Trump, who's had a long-standing sort of dislike for a large trade balance, something that he picked up from Lee Iacocca. This is well documented. Lee Iacocca was always concerned about having a large trade deficit. This is one of the reasons for the tariffs, is to reduce that trade deficit. And winner, winner, chicken dinner. That is precisely what President Trump has accomplished. Lowest level since 2009 without the normal sort of slowdown in the economy. And so, I mean, whatever you I'm not a fan of tariffs. I'm on the record very clearly against tariffs. I think they're a bad idea. I wish I had the saying. I don't have the saying pulled up. Scott Lincecum, of course, sort of. I don't know if he coined it or if I think he might have coined it, but it's something about how tariffs, basically don't actually do what they're trying to do. They create a lot of confusion, a lot of problems, and they mostly just create sort of chaos. A lot of rent seeking that happens with tariffs. So I'm not a big fan of tariffs at all. But I mean, if you're someone, I mean, I didn't think tariffs were, I thought they were either going to be impactful to the point where they were going to destroy the economy, and that's how they were going to lower the trade deficit, or they weren't going to have an impact and we were going to see the trade deficit rise regardless. I was wrong. They found a way to lower the trade deficit and keep the economy humming along. Now, we're going to find out what's actually happening in the fourth quarter. We don't know. It could potentially be a negative quarter because of the government shutdown. We've already heard economists sort of argue that the fourth quarter could be a negative print. So we will see. But even just kind of looking at the overall economy, things aren't great in manufacturing. You know, we talked about that at the beginning of the week. We had the ISM report showing that manufacturing did not have a good 2025. A lot of anger about tariffs, sort of the overall impact of tariffs have not been great for U.S. manufacturing, not to mention the fact that we've seen employment stumble, which the whole idea behind the tariff argument is that we reduce our trade deficit and create more jobs in the United States. The exact opposite has happened, where we've actually shed, I think it was like 100,000 jobs or something along those lines in manufacturing over this year. The manufacturing sector in the United States is not happy, but it has not caused massive problems or a major slowdown of the economy. So kind of trying to rate tariffs, you could say, okay, it did exactly what they wanted, which was lower the trade deficit. But we have not got that boom in U.S. manufacturing, where you're seeing a lot of suppliers in the manufacturing industry are still very frustrated by the rise in cost of their inputs in order for them to be able to make their products. And we have not seen that increase in manufacturing employment. In fact, quite the opposite. We've actually shed a lot of jobs in the manufacturing sector. But like I said, it hasn't caused that slowdown in the economy. So, and we'll see that. Like I said, we're going to find out exactly what is happening with the fourth quarter in the United States, which some have projected could be a negative number. But President Trump, long-standing argument that he has been against a large trade deficit and wanted to shrink it. And damn if he didn't do that. I mean, he did it. And it like I said, it seems very successful, and that we have not seen the deficit has not come at the expense of overall economic growth. But it also hasn't caused expansion either. So if you're one of the people who believes in the sort of mercantilist system where it's like, oh, we're actually having a lower trade deficit means more economic growth and more sort of stimulation for the domestic, not only manufacturing aspect of the economy, but the overall economy, that has not happened either. In fact, far from it. So like I said, it's still kind of difficult to score because it's like, boom, he got that, but where's all the other benefits that are supposed to be happening by having that lower trade deficit? So, like I said, not directly related to mortgage rates, but interesting with regards to a look at the overall sort of economic growth of the U.S. economy. All right, we do have a jobs report coming out tomorrow, and that's supposed to be great. We're also going to be getting housing starts and building permits, I think really for the first time since the shutdown, I think. So kind of a busy Friday, so I may have to do a show, but like I said, whenever I say that, I tend to not do one. So maybe Monday, we will see. But if I do a show or not, enjoy your Friday. Enjoy your weekend if I don't talk to you. And of course, we'll be back here Monday afternoon for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.